Welcome to Daddy's Event Enterprise, a name that stands for premium, high-end event management. But even successful businesses need to stay compliant with tax laws. Meet Hamdi, the owner of the company. While he's excellent at organizing unforgettable events, he's currently facing some tax-related issues. In this video, we'll break down how Hamdi mishandled certain employer obligations, what he can do to fix them, and the consequences if he doesn't. Let's begin by understanding the basics. Monthly tax deduction, or MTD, is a system in Malaysia where employers are legally required to deduct a portion of their employees' monthly salaries to cover income tax. This amount must be calculated based on official tables provided by LHDN and must be paid to the Inland Revenue Board, IRBM, by the 15th or 20th of the following month. This ensures employees stay tax compliant without having to worry about annual tax submissions unless there is additional income involved. Now, let's look at the MTD-related offenses Hamdi committed as an employer, specifically under his duties outlined in Section 107 and Section 107C of the Income Tax Act 1967. The first offense is making incorrect MTD deductions. According to the official MTD tables, Zahidi, who earns 4,100 ringgit per month, should have had 84 ringgit and 85 sen deducted monthly, totaling 1,018 ringgit and 20 sen for the year. Azri, who earns 5,050 ringgit monthly, should have had 168 ringgit and 65 sen deducted per month, totaling 2,023 ringgit and 80 sen annually. If Hamdi deducted any amount less than these required figures, it constitutes underdeduction of MTD, which is a breach of the income tax. Deduction from remuneration, Rules 1994. This offense violates Section 107C, which requires employers to deduct the correct amount of tax from employees' monthly remuneration. Even small shortfalls may result in penalties from the Inland Revenue Board of Malaysia, IRBM. The second offense is under-remitting MTD to the IRBM. Although Hamdi did remit MTD payments for Zahidi and Azri 1,000 and 2,000 ringgit respectively. These amounts are slightly below the total required amounts. This shortfall indicates under-remittance, which means Hamdi failed to fulfill his statutory responsibility to remit the full amounts deducted to the IRBM. Under Section 107 of the Income Tax Act 1967, employers are obligated to remit the exact amount deducted from employees' salaries to the IRBM on time. Any discrepancy, whether due to oversight or deliberate action, is considered an offense and may lead to fines, penalties, or legal prosecution. Now, let's switch roles from Hamdi as an employer to Hamdi as an individual taxpayer. On 12th June 2024, Hamdi submitted his Form B for Year of Assessment, YA 2023. However, during a desk audit conducted on 31st August 2024, the Inland Revenue Board of Malaysia, IRBM, discovered that Hamdi had failed to declare rental income amounting to 24,000 ringgit. Under Section 4D of the Income Tax Act, 1967, rental income is taxable and must be declared in the annual income tax return. Due to this omission, Hamdi was issued Form JA, a Notice of Additional Assessment. To contest this, Hamdi has the right to appeal the additional assessment by submitting Form Q within 30 days from the date Form JA was issued. This form serves as a formal objection to the IRBM's assessment. In his appeal, Hamdi must include a valid explanation for the omission, such as a misunderstanding, clerical error, or the possibility that the rental was not actually received in YA 2023, and attach supporting documents like tenancy agreements, payment receipts, or other evidence. The appeal process is protected under Section 99 of the Income Tax Act 1967, which ensures taxpayers have the opportunity to clarify or dispute any discrepancies before enforcement action is taken. If the IRBM finds the appeal reasonable, the additional assessment may be amended or withdrawn. Now here's the part Hamdi may not have considered: his plan to travel abroad before settling his outstanding taxes. Under Section 104 of the Income Tax Act 1967, if a person has unpaid taxes, the Director General of Inland Revenue has the authority to stop them from leaving the country. This is usually enforced through a travel restriction notice issued to the Immigration Department. So, what can Hamdi do? He has three options. First, he can pay the outstanding amount in full. Second, he may request to pay in installments, but this must be approved by IRBM beforehand. Third, he can provide a bank guarantee or similar financial security as assurance that he will settle the taxes. Without doing one of these things, Hamdi may be stopped at the airport during immigration clearance. Trying to leave without resolving tax issues can lead to not just embarrassment, but also legal consequences, including fines or seizure of assets. Let's recap what we've learned. Hamdi, as an employer, committed 2 MTD-related offenses, which are under-deducting tax from employee salaries and under-remitting the amounts to IRBM. As a taxpayer, he can file an appeal regarding the undeclared rental income using Form Q within 30 days. However, if he plans to leave the country before resolving his tax matters, he risks being barred from traveling under Section 104 of the Income Tax Act. Thank you for watching this important breakdown on tax responsibilities, presented by Group 3 of AC1104C. Stay informed, stay compliant, and stay on the right side of the law. Goodbye.